we have unemployment at 3.9%. We have hourly wage growth coming in April at 0.1%. Now, to me, that seems like a disconnect. You've written that there's no great mystery. Can you unpack that a bit for us?
Yeah, I think it's no great mystery. I mean, I think there are a few reasons. One, the month-to-month numbers are pretty much useless for inferring the underlying trend. These numbers jump around. There are some significant calendar effects. Those were negative in April. So I think that's important background for the 0.1%. If you look at it on a year-to-year basis, which gives you a somewhat better gauge, we're at 2.6% for hourly earnings. And that's also, I think, what you see from other indicators of wage growth, something in the 2.5% to 2.75% range. That is a little disappointing, I think, relative to what you'd expect in a full employment environment. But I wouldn't overstate it. The pace of wage growth that you can sustain at full employment is quite a bit lower now than it was 10 years ago, 20 years ago, 30 years ago, basically because productivity growth has been so much weaker than in past decades. So it used to be that maybe the speed limit for hourly wage growth was 4% or a little over 4%. Now it's probably more like 3%, and we're not that far away from that. Third point to keep in mind is that we can also look at surveys of wage growth in addition to the hard wage indicators. Those have actually picked up quite a bit over the last 6 months or so, and they do suggest that we'll get to that 3% or 3% plus rate before too long. That would be our expectation by early next year.
All right, but let's take those points for a second. So you have relatively low unemployment, you have some wage pressure, you have some inflationary pressure, you have what looks like it may be a labour shortage coming. That looks to me a lot like the end of a period of expansion. Is that where we are?
I don't think we're at the end of the expansion. In fact, I think risk of recession in 2018, 2019 is pretty low still. On the demand side, we're still getting a good boost from fiscal policy in particular. We think that probably contributes something like 0.75 of a percentage point to growth. And on the supply side, while clearly we're moving into a labor shortage environment, I don't think we're far beyond full employment yet. Maybe we're a little bit beyond full employment, but we're still at a point where the Fed can be fairly gradual in normalizing monetary policy. So they're very much locked, I think, in the near term on a once per quarter kind of hiking schedule. I think, as you get into late 2019, 2020, the risk of recession does go up because on the demand side, we're losing the fiscal boost. And then in terms of the amount of slack out there, I think we'll probably be more clearly beyond full employment. We have the unemployment rate at 3.25% by the end of 2019, and inflation somewhat above the target. So I think at that point it will require a pretty nimble monetary policy to achieve a soft landing in 2020-21. We're not forecasting a recession, but I think the risk does go up at that horizon.
Now, we know President Trump likes to take credit for the low unemployment rate. He does a lot that concerns economists. You look at NAFTA, you look at some of the trade tariff stuff, even stuff like pulling out the deal with Iran. But what does he do that makes you guys bullish? What do economists like about Trump at the moment?
So I think in general, most economists are pretty negative on trade restrictions, and that's true, I think, on both sides of the spectrum. I think most economists agree that the U.S. corporate income tax reform was somewhat overdue. The U.S. was towards the very high end in terms of corporate income tax rates, and broadening the base and cutting the rates was something that I think enjoys a lot of support. There is I think, a debate around the timing of that of that move. We're seeing fiscal expansion late in the business cycle with the unemployment rate already at very low levels. So there is a bigger risk of basically overheating things. But I think the basic idea of corporate tax reform enjoys quite a lot of support. I think again, it seemed somewhat overdue, and obviously the Obama administration had tried to make some changes there already, so there's some degree of bipartisan support for it as well. And then I would say on the regulatory side, it probably is a bit more split into which side of the aisle you're on. But there are certainly also a number of economists who think that deregulation or streamlining some of the regulations is going to have positive effects on growth. I think that's a bit more, a little less clear what the size of those effects is going to be. But I think on taxes, that's probably the area where the support is the strongest.
So we seem to go from these geopolitical shocks to geopolitical shocks at the moment. Sometimes it seems in the space of a week you have what you would normally have in a year. But the market, it kind of just rides them out. What, if anything, should clients really be worried about at the moment? What is the shock that's going to maybe bring this bull market to a close?
I mean, I think the biggest things to be concerned about are probably around what we've talked about, namely the possibility that the economy overheats eventually, inflation rises more significantly above the target. The Fed ultimately is still committed to getting something like 2% sort of cemented, and therefore has to be more aggressive in slowing things down. Once the unemployment rate starts to increase, it tends to be very difficult to calibrate that in a way that pulls off a soft landing. There's never been an increase in the U.S. unemployment rate of more than 35 basis points on a 3-month average basis that wasn't associated with a recession. That's not a law of nature, but it does suggest that doing these sort of soft landings from below is harder. And if that is coupled, a situation where the economy is already growing at a below-trend pace, the Fed's trying to slow things down. If that's coupled with a more significant shock from, financial conditions or perhaps oil prices, that's another, common factor or common concern that you get an oil price shock. I think then the risk of recession would go up.